Hey guys, hope everything's going well. You guys know that drill. Smash that like button, subscribe if you haven't, comment down below. Follow me on Instagram at AIH Sports. That is my sports card channel. But once again, if you want to talk to me, communicate with me, always go there. Even though I post pictures of sports cards and collectibles, etc. Now, I want to talk about the economy. The economy, a lot of people are worried about it. There's inflation, people say. And yes, it's been the worst inflation in the last 40 years. And GDP has been negative the last two quarters. But Q3, I believe this will be a positive quarter for GDP. And here's a few things. Oil has tanked from the highs of the initial Russian-Ukraine turmoil that started earlier this year. And I think oil futures were $130, and now you see oil close to $80 in the futures contract. And there was also some people that I follow at Eurodollar University, Emil Kamalnowski. I may be butchering his last name, but he has a very good podcast, interesting podcast. And I think one of the graphs they had is that the lines were showing less of a backwardation in crude oil, which shows that, okay, crude oil isn't showing too much price appreciation in the future. The wider the spreads that there are in the crude market, then the more probability that there will be a higher oil appreciation in the future, or you're going to see much higher oil prices in the future. But once again, you just can't use that metric to determine oil prices. But this is one of the research that I saw. So you're seeing, first of all, oil going down, right? We're still inflation year over year. Let's not forget about that. But you have to look at quarter over quarter difference of the rate of increase in inflation. Just like when I used to do corporate finance or accounting work, I remember my old boss. He used to say, hey, what's the rate of change in top line growth? What's the rate of change on the expense side? And you looked at the changes quarter compared to each quarter. And if you're looking at inflation, inflation actually isn't rising to the extent that we've seen in the past. Maybe compared to year over year, okay, yeah, it's up, but quarter over quarter, no, it's not. And if you look at that and apply that to the GDP calculation for real GDP, GDP should be positive, in my opinion. And if you have positive GDP, I believe that the people that were bearish will become bullish, and that will help the market rally, in my opinion, for the next 1 to 2 years, as I've stated for quite some time. 2024, after that, it should be a challenging year. 2025 should be challenging. But once again, you have to see more data as the time approaches. And you have to always keep an open mind for the data that you see. Now, if you also look at the currencies, I'm eyeballing the US dollar index very carefully. And I've seen in the comment section say that, hey, look at China. China is the reason the dollar is going to continue to go higher. Here's my rebuttal. The dollar index consists of a basket of currencies. The majority of the US dollar index consists of the the euro. And that's approximately 58% of the currency, or of the basket About 10 to 11% is the British pound, 10 to 11% is the Japanese yen. So for the dollar index to go down, you'd have to see the euro rally. Today was a day that the euro rallied, and you saw equities pop up. You saw precious metals pop up. I believe Bitcoin was up as well. And if we see that, and yes, I do believe there will be volatility, but if that index, or if the euro does rally, despite the problems that they have, despite their dependence on Russian energy, which they no longer can depend on, if you see that euro rally, that would mean, in my opinion, the dollar index goes down, and that bodes well for many asset classes out there, because the dollar is way too strong comparatively to, or for the markets to rally. A strong dollar is not beneficial. There were times where a strong dollar did help, very strong dollar in the 1980s, but if you look at it, yes, you can have a market rally at the strong dollar, but it does hurt the equities market, in my opinion, especially when the economy doesn't have tax cuts like you did in the 1980s, or if you didn't have a robust economy in the 1990s. It's a little different situation going on today. And I've noticed the other thing today, when the euro went up and the dollar went down, I was looking at the interest rate differential. I was looking at the 10-year yields. I noticed that the 10-year yield went down 7 basis points. And if I looked at the German 10-year note, it went down maybe a basis point or two. Same thing with the French 10-year bond. It didn't go down significantly. So you're looking at the interest rates, comparing those. So the bonds were rallying and interest rates are going down much more than the German and the French bonds. Could that have been a reason why the euro rallied? Could have been. And I'm just looking at the bond market in general. I'm looking at what it was in 2020. I believe the 10-year note, I can't believe this, it was 30 basis points from my memory in 2020. I think it hit it twice. And then you saw the market for bonds, you started to see bonds sell off. And right now, the 10-year yield, is like 3.2%? So you're seeing a 300 basis point move in the last few years. And while the Federal Reserve has been raising rates, and also you're looking at geopolitical events, you've seen a flight to safety in the US dollar. Now, what happens when the Federal Reserve says that, hey, we're not going to raise interest rates too much now. We're still going to raise it, but we want to make sure inflation has been controlled. And then the ECB, on the other hand, is aggressively raising interest rates because of their policies dealing with the Russians. And their inflation, part of it is due to the geopolitical events going on. Their dependence on Russian energy, and now they have to pay much more because of sanctions and all that stuff. And now you have to also look at, okay, there's this easy money that came about. So the ECB is going to be aggressively raising interest rates, in my opinion, while the US is not going to be raising interest rates as much. There could potentially be a pivot. So in terms of interest rate differential, I could see the 10-year yield go down much more than the German 10-year yield and the French 10-year yield. And because of that interest rate differential, I would expect the dollar index to go down. I would expect equities to go higher. I'd expect precious metals to go higher, Bitcoin, You could look at the other collectibles markets that I'm in. And just based on all of that, I'm looking at right now to accumulate stocks that have taken a beating. And what will be good if interest rates go down? I would say technology. And I don't know, this is not investing advice, this is just me thinking out loud. So, yeah, let me know what you think, guys. Remember to smash that like button, subscribe if you haven't, and if you want to always message me on IG at AIH_sports, guys. All right, guys, talk to you later. Bye.